Good morning, everyone. Thank you so much for joining us today for our tax season update webinar. We have Ed Saney and Erica Lacey to present all of this helpful information for you. So I will let Ed Saney kind of kick it off for us today.
Thank you, Morgan, and welcome everybody. As you know from our advertising, Saney and Associates is a CPA firm. We have offices in New York State and the state of Florida, and we perform work for clients in over 36 states, currently for tax, accounting, auditing, and many other accounting services. You can look on our website for our menu of services we offer, and they are also shown at the end of this presentation. We also own a few more entities that are all involved in assisting our current and future clients. We own a franchise named Trans World Business Advisors, where we help clients that would like to buy or sell a business. We have certified valuation analysts on staff providing any kind of valuations and performing due diligence work. Again, that's part of our succession planning with strategic meetings that we hold with our clients. We also own a company called Elite Business Solutions, where we offer virtual bookkeeping and CFO services for small businesses. We have bookkeepers and specializing in all realms of business, along with even government accounting specialists throughout the country. Biz Collections is another entity, which is a third-party debt collection company, assisting in financing and collection alternatives and also in debt restructuring. TLR is a book publishing company, which we have instructor and student guides for QuickBooks training. We use this in webinars and even in training for QuickBooks, and we sell these to colleges and universities. We also have some niche books presently for construction industry, law firms, and even the new QuickBooks Online teaching guide. And last but not least, we have Clear Choice Capital, which is a third-party commercial loan agency helping to facilitate all types of loans, commercial and SBA loans, equipment loans, lines of credits, and any other type of financing needs, and again, debt restructuring. I know it's a lot to swallow, so if anybody feels that they'd like more information on this, please feel free to follow up and give us a call. And now I'd like to allow Erica to take over with a deep dive into our webinar. Thanks again.
Hi guys, so today we'll be reviewing 2022 and 2023 items related to income limits and the standard deduction, rates for capital gains and qualified dividends, retirement plan contributions and their corresponding rate increases for 2023, the child tax credit and the child independent care credit, the residential clean energy credit for 2023, and the vehicle tax credit also for 2023, tax deductions and limits relating to business miles and the HSA contributions. We'll also have a Q&A session at the end. So just as a reminder, we'll have a Q&A session at the end, but please feel free to send those questions as they come up. 2022 and 2023 income limits and the standard deduction. The standard deduction has increased for 2023 significantly more than in prior years due to inflation. The standard deduction is a fixed dollar amount that reduces the income you're taxed on. Your standard deduction varies according to your filing status. There is an additional deduction for taxpayers that are 65 and over or blind, and that is increased by $100 from $1,400 to $1,500 in 2023. The standard deduction or the itemized deduction. Many taxpayers claim the standard deduction due to the ease of not having to keep track of expenses. It is better to itemize if you have a large amount of out-of-pocket medical expenses, dental expenses, paid real estate tax, mortgage interest, and made large donations to qualified charities, since all of these items make up your itemized deduction. As you can see for 2023, many of the tax brackets for each filing status have increased over the 2022 amounts. The tax brackets are adjusted each year to account for inflation. As a result, tax brackets have widened in 2023. When a tax bracket gets wider, there's less of a chance that you'll end up in a higher tax bracket if your income stays the same or doesn't grow at the rate of inflation from one year to the next. We'll be sending out this PDF after the presentation, so you'll have a chance to review this table and see how the widening brackets affect you.
Just one point there, Erica, too, and to everybody, Congress was threatening to make that maximum tax 39%, and as you can see here, even for 23, it is staying at that maximum 37%. So nothing has happened on any of that.
Perfect. So capital gains and qualified dividend rates. What are capital gains? Capital gains are generated from the sale of stocks, bonds, cryptocurrency, real estate, and other capital assets. The rates that apply depend on how long you've held the asset before selling it. If you hold a capital asset for 1 year or less, any gain from the sale is considered a short-term capital gain and taxed using ordinary rates listed on the previous slide. However, if you hold the asset for more than 1 year, the gain is treated as a long-term capital gain and taxed at a lower rate, either 0, 15, or 20%, depending on your taxable income. The long-term capital gain brackets are set up so you'll generally pay a lower rate of tax.
And again, on that, Erica, just to point out, we do a lot of tax planning by the end of the year, but if you're only on a fixed income, Social Security, and have capital gains, you can see here that you could possibly generate up to $83,000 of capital gains and pay no income tax on it.
Yeah, you get pushed into that 0%. Contribution limits. The contribution limits for traditional and Roth IRA plans increased $500 in 2022, up to $6,500 in 2023. Additionally, the age 50 catch-up limit remains at $1,000. The income range that determines one's eligibility to make deductible contributions to traditional IRAs or contribute to a Roth IRA have also increased. Employer plans like SEP IRAs and simple IRAs saw a change as well. The contribution to a simple IRA increased by $1,500 to $15,500. If you are age 50 or over, the catch-up contribution limit also increased, making it possible to contribute an additional $3,500 for 2023, up from $3,000 in 2022. For those with a solo 401k, the limit for the total contribution is increasing from $61,000 to $66,000. For SEP IRA, contribution limits will increase to $66,000 per year for 2023, up $5,000 from 2022. The deadline for contributing to your 401k was December 31st, but there's still time to invest in your traditional and Roth IRAs, as the deadline is April 18th, 2023. Any notes on that, Ed?
No, I'm good with that one. Thank you.
Okay. So the child tax credit. American Rescue Plan enhancements have expired. The child tax credit has reverted back to its pre-2021 form and has dropped back to $2,000 per child. $1,500 of that amount is refundable. Children 17 and over do not qualify for the credit. Annual income must not be more than $200,000 for single taxpayers and $400,000 for married filing joint to qualify for this credit. Child Independent Care Credit. For 2022, the Child Independent Care Credit is non-refundable. You may claim the credit on child care expenses up to $3,000 if you had one child or $6,000 if you had two or more children. The maximum credit is 35% of your child care expenses. The more you earn, the lower the credit. Once your adjusted gross income is over $43,000, the maximum credit is 20% of your child care expenses. So if you earn under $43,000, the maximum credit you would receive would be $1,050 for one child or $2,100 for two or more children. If you earn more than $43,000, the credit would max out at $600 for one child and $1,200 for two or more children.
Yeah, that was reduced from last year then, right, Erica?
Yeah, it did reduce because of the American Rescue Plan enhancements expiring. I think it was almost double last year. So the residential clean energy credit for 2023, homeowners that install residential clean energy units may be eligible for the residential clean energy credit. This credit is available for the installation of residential solar, small-scale wind, geothermal heat pump, home battery storage, and fuel cell energy systems. Each of these installations is subject to its own set of eligibility criteria and maximum credit limits. If this credit is greater than the taxes owed by the taxpayer in a given year, the excess credit may be carried forward into the next year. Electric vehicle tax credit for 2023. The Inflation Reduction Act of 2022 changed the rules for this credit for vehicles purchased from 2023 to 2032. It is a $7,500 non-refundable tax credit that is available to individuals and their businesses. The vehicle must be new and qualified as a plug-in or fuel cell vehicle. To qualify for the credit, the vehicle must be purchased for your own use, not for resale, must be used primarily in the United States. The taxpayer's modified AGI may not exceed $300,000 for married couples filing jointly, $225,000 for head of households, $150,000 for all other filers. You can use your modified AGI from the year you take delivery of the vehicle or the year before, whichever is less. If your modified AGI is below the threshold in one of the 2 years, you can claim the credit. The credit is non-refundable, so you can't get back more on the credit than you owe in taxes, and you can't apply any excess credit to future tax years. There's quite a list for a vehicle to be.
I'm sorry about that, Eric. I just want to add in one thing. Any Northeast where you have a state income tax, there is available credits on the state return too for some of these, in most of the states.
Okay, yeah, I think that was true for the residential, or for this residential clean energy credit as well.
Correct, thanks.
So if you find a vehicle that you think qualifies for this credit, you may want to do some research because there is quite a few qualifications that have to be met for it to qualify. So 2022 and 2023 tax deductions and limits. The standard mileage rate beginning in 2023 is 65.5 cents per mile, and that applies for business use. And the 50% meal deduction has returned for 2023. The health savings account contribution limits are expected to increase. For single coverage, it will go up to $3,850, and that's an increase of $200 from 2022. Oops, sorry about that. For HSA accounts with family coverage, you can expect to see limits go up to $7,750 in 2023. And those who are 55 and older will be able to contribute an additional $1,000. So the Secure Act 2.0. In the final days of 2022, Congress passed a new set of retirement rules to make it easier to contribute to retirement plans and access those funds for retirement. So the main changes were the age increase. So for people in or near retirement age, the age for RMDs increases to 73, starting in 2023. So if you turn 72 in 2022 or earlier, you will need to continue taking RMDs as scheduled. the age increases to 75 in 2033 for the RMDs. So there's also a decrease in penalties starting in 2023. The penalty for failing to take an RMD decreases to 25% of the RMD amount not taken. And it will be reduced to 10% if the amount is withdrawn and the the penalty will be reduced to 10% if the owners of the account withdraws the RMD amount not previously taken and submits a corrective tax return in a timely manner. Additionally, Roth accounts in employer retirement plans will be exempt from the RMD requirement starting in 2024. Higher catch-up contributions. Starting in 2025, individuals ages 60 through 63 will be able to make catch-up contributions up to $10,000 annually to a workplace plan. That amount will be indexed to inflation. There's also going to be an emergency savings. Defined contribution retirement plans will be able to add emergency savings account that is a designated Roth account eligible to accept participant contributions starting in 2024. Contributions would be limited to $2,500 annually, and the first 4 withdrawals in a year would be tax and penalty free. Charitable contributions. Charitable contributions apply to individuals who itemize, and donations are limited to 60% of federal adjusted gross income. If you are 73 or older, the IRS rules require you to take a required minimum distributions, as we discussed in the previous slide, each year from your tax-deferred retirement accounts. A QCD is a direct transfer of funds from your IRA payable directly to a qualified charity. Amounts distributed as a QCD can be counted towards satisfying your RMD for the year up to $100,000. The QCD is excluded from your taxable income. This is not the case with a regular withdrawal from an IRA, even if you use the money to make a charitable contribution later on. If you take a withdrawal, the funds would be counted as taxable income, even if you later offset that income with the charitable contribution deduction. Why is this distinction important? If you take the required minimum distribution as income instead of as a qualified charitable distribution, your required minimum distribution will count as taxable income. This additional taxable income may push you into a higher tax bracket and may also reduce your eligibility for certain tax credits and deductions. For example, your taxable income helps determine the amount of your Social Security benefits that are subject to taxes. Keeping your taxable income level lower may also help reduce your potential exposure to the Medicare surtax. Corporations' charitable contributions may not exceed 10% of taxable income. Do you want to add anything, Ed?
No, I think you covered everything well there, Erica. Good.
All right, so here's a list of our services. We do offer a lot of various services in our firm. So while we address some questions, I'll leave this up in case you're interested.
Thanks, Erica. We do have a couple questions that have come in so far, and while we're going through those, I just wanted to remind everybody to stick your questions in the chat box or the Q&A box below, and we will be monitoring those. If for some reason we don't get to your question or you have anything at the end, I will be sending out an email with the recording of this webinar and the PowerPoint, and you can reply to that email with your questions or to set up a meeting with Erica or Ed or anything. Okay, the first question is, what are the tax effects of me donating stock to a charity?
Good question on that, because one thing they did is they changed some of the laws this year for 22 taxes compared to what it was last year and the last 2 years, where COVID apparently hampered some of the charitable contributions, and they were allowing everybody almost full deductions, 100% of their adjusted gross income that they could do in cash. And I think they increased it to 60 or 70% for stock, appreciated property. Appreciated property would be common stock. It could be real estate, it could be art. And the limitations went back in a way to pre-COVID days where any appreciated property is limited to 30%. And it used to be capped with 50%, but and as you can see on our presentation there, it is for 22, it's 60% for cash and 30% for art. So the issue would be if you had $100,000 of stock, appreciated stock, you can get the total deduction for that 100 instead of selling it, paying the taxes on it, and contributing it. You would get the market value deduction, but that 100,000 would be limited of what you could take as a contribution to 30% of your adjusted gross income. So if your adjusted gross income was 200, you would be limited to a $60,000 deduction on that $100,000 contribution of the stock into a charitable organization. And that excess 40,000 would be carried over to the next year under the same limitations under 30%, but not as your regular cash. But it's a very good year-end tax planning maneuver to do and to look at. And if you were going to be selling or not needing that money and wanted to do your philanthropic duties with appreciated stock, it's the best way of doing it.
Perfect. Thanks, Ed. Next question. Can I roll over more than my RMD into a qualified charity?
I can do that one, Erica, because you said, Ed, is there anything else about RMDs that you wanted to talk to? And I was just thinking, and when you're showing our menu of services with estate planning and all that, we've done that many a times. Everybody thought, so your RMD, let's just say you have a minimum of $70,000, the answer would be, can you do more? Can you take a distribution? Well, if you're over the age, you have a choice of taking as much as you want out of your deferred accounts, 401k, IRAs, whatever they are. So you can take as much as you want out of there, but you have to take your required minimum distribution. So if you took out $100,000 and your required minimum distribution is $70,000, you could definitely contribute up to $100,000. And as pointed out earlier, it's $100,000 each. So if you and your spouse have both deferred plans, you could get away with taking out $200,000, putting it into a charity you want. But what in estate planning, what we've been doing is creating private foundations, charitable organizations for the family. And having that deduction is a wash. And as Erica's saying, it doesn't affect your adjusted gross income. And you could be putting $200,000 away, where many people have told you in the past that these 401ks are bad because you're going to be having to mandatory report them and pay taxes at a higher level. You're avoiding 100% of any kind of tax recapture and perhaps creating an estate planning function of a foundation that will go on in perpetuity.
Okay, great. It looks like there's no more questions at this time. Oh, hold on. My in-laws are living with us. Would adding them as dependents help us in the long run when it is time for my daughter to start applying? When is it time for my daughter to start applying for financial aid? I think those are two separate questions.
Well, yes and no, I think. It's talking about having more dependents, so it lessens the amount for the college, perhaps for the application for the funding and the loans, I think. Erica, you got anything to share on that one?
Yes, that's what I meant, is what she said.
Okay. Okay. Yeah, so it would show as dependents. There's some specific things out there under the code for taking an in-law as a dependent. Of course, they're living with you, you're paying food, clothing, shelter. It's got to be over 1/2 their support. There's an income limit that they cannot have. However, if they're only on Social Security, that is not covered. So if the assumption, the perfect world would be they live with you, they live off of you, and they only have Social Security, then they would add on as dependents of yours, which would probably lessen that blow of the qualifications that they have on the income thresholds for student loans.
Okay, I hope, which they do, they fully depend on us. Thank you. That's the reply. Okay, so hopefully that helps. Thank you for your question. Next question, is the electric vehicle tax credit available to a business that owns the vehicle?
I can go
I
back
do.
to that slide.
Go ahead.
And
Go ahead.
yes, I believe it is available to to businesses. So right here, available to individuals and their businesses, as long as you're using it in the business and you're not purchasing it for resale.
And one more thing on that I might want to add, because we've been doing this with our year-end planning with many of our car dealers that are required to be accommodating the EV, the vehicles in your business. If you do plant charging stations too, there are available credits for that too, depending on where you are, what state you're in, but there are federal and state credits for even putting in those EV charging units.
Okay. Thank you both for answering those questions. I think that those were our last questions. We thank everybody again for joining us today. And Erica, if you'll just pop up that last slide real quick. Ed and Erica's contact information are on the screen if you do have any additional questions. But like I said, I will be sending out this webinar to everyone that joined us today. So you'll have our contact information there as well for any questions that might pop up, or if any additional meetings you'd like to schedule or anything like that. So thank you so much for taking time to join us today. And thanks, Ed and Erica, for going through all this information.
Yeah, thank you guys. Thanks for attending.
Chiming in.
All right. Bye, everyone. Have a great day.